you very much, Shane and Follow Me, for hosting this session. It's a debut live webinar session with Ron William discussing markets in mind, equity market crash, what next? For any of you who would like to stay in touch, I'm very much available on all social media platforms, including WeChat, logo there on the left-hand corner, and direct on email, rwilliam@rwaadvisory.com. Now, I want to begin with a video which will be available on the Follow Me platform very soon. Just one moment. Just one moment. I'll prepare it for you. We'll listen to this video now, which sets the scene for what we're going to discuss, focusing on markets, but very much also discussing a very popular topic, seeking alpha in a VUCA world. How do we make money in a world that is turned upside down? Volatility is up, uncertainty is here, and the complexity and ambiguity of the world is very much making things that much harder to do in terms of trading and investing. So I want to kick off with that video question about seeking alpha in a VUCA world, volatility, uncertainty, complexity, and ambiguity, by asking you the question, the V part of VUCA, volatility, what does volatility mean to you? So hopefully, Shane, there should be a survey set up or a poll set up with that opening question. Is that good to go? Is that ready? Do we have the poll ready on what does volatility mean to you? The three questions are opportunity, risk, or uncertainty. So if you can see the poll there on the screen, please answer accordingly. Otherwise, just type in your answer on the chat. What does volatility mean to you? Risk, opportunity, or uncertainty? Do we have the poll on the screen there? Just a quick check. I'll give a few seconds just for all of you to reflect on that question. What does volatility mean to you? Risk, opportunity, or uncertainty? Now, many of you will potentially think any one of those three things. Risk is actually the most popular question that gets asked and assumed. But of course, many of you will see the trading opportunities as other traders might see the risk. And this is a concept that I make sure we learn out of principle, which actually is born from Eastern Chinese philosophy. And this is the idea of crisis leading to an opportunity. So the Chinese proverb and the Chinese yin-yang kind of balance, where there's this two-sided nature to many events in life and in markets, and even in the current pandemic situation with the COVID-19 virus that is taking place. And many years ago, the American President John F. Kennedy actually quoted the Chinese saying about danger and opportunity being different sides of the same coin. So I've just been advised here by Follow Me that you all engaged in the poll, which is great. So thank you very much for engaging in that. We want to make this session as interactive as possible and make sure that we're sharing your voice and your sentiment on the ground. Now, volatility, of course, is definitely here this year and likely to stay for a few years ahead. That is my view. And this is a chart which is partly out of date, but still the message is clear. And it's a chart of volatility based on the VIX index, what is often called the fear index. It's a measure of the option contracts on the S&P 500, so US equity market. And every time you see it spike up, that's fear in the market. Every time you see it push down, that is complacency, people being comfortable in the market. So we go from fear to complacency in this pattern on the market. Now, this goes back to 2015. You can see this is we see patterns that exist in the market where the volatility compresses. It goes from high to low. It squeezes into this triangle wedge formation, for those of you who are looking for a technical terminology. It happens once, twice, 3 times, 4th, and then the 5th time we get a big lift-off rocket launch into the start of this year. Now, I showed this chart at an exclusive Follow Me event in late last year, and it was a popular chart there, which you can also follow on my Follow Me account to look at kind of new updated views. But this is definitely one that was shown live at the Follow Me event in mainland China late last year, and then I shared it on my Follow Me social media feed. What it shows, of course, is the spike that was originally post Chinese New Year, the coronavirus situation. And then, of course, that was made worse by the oil shock. So Saudi basically forcing the oil prices lower onto record lows vis-a-vis rising tension between Saudi and Russia amidst this OPEC breakdown. Now, just a little bit about myself and how my journey has experienced volatility over the last 20 years. So my main focus has been in strategy, education, and performance coaching. As part of that strategy side, my first and best experience of volatility is through trading my own money. And so a long time ago, I did exactly that. And my first trade was one of my best trades. I made good money, but the real story behind the story is on the second trade, I lost a lot of the money that I made. And the reason behind that was, poor risk management. I didn't really have good risk management rules, but also I didn't have trading rules either. So I really learned through experience that making money during a winning trading position is a good thing. Of course it is. You're making money, you feel good about it. But if you're not learning any lessons in the process, that's a problem. And so I only learned my lessons after I lost the money that I originally made. And that's really an important lesson that I want to share with you about how I started my journey in the market. It really is a psychological journey. And that's why so many years later, I really started to focus a lot more on the psychology of trading as well as the strategic side of trading in terms of developing a strategy and then also risk and money management perspectives. Now, I've done that for many leading institutions, banks, funds, and brokers. The focus I have is a global focus. I look at all markets around the world, multi-assets. So think of the equity market, currency market, commodity market, bonds, but also digital currencies I look at. And I look at things from a big picture perspective and then drill down. So top down. And often it's a blended approach, a mixture of technical analysis, but then also economic, fundamental, and just general macro focus. All of this blended open approach is driven by cycles. And in terms of my trade psychology, it's really focused on behavioral finance and often a review of how your behavioral mistakes show up on the portfolio, on your actual trade performance. And then, of course, in today's market, the stress of the volatility is important. So I do a lot of stress response management, how to actually improve the chances of you trading in a focused way under stress. Now, a lot of the work that I do also has a big education drive behind it. I also am part of the International Federation of Technical Analysis, part of their education committee. They have a global standard in technical analysis. So for any of you who want to actually have a formal education in trading and investing, IFTA is the recommended platform that I would suggest you look at. Now, the second poll question, which I'd like to ask you, is at what stage of the cycle do you think we are in terms of world markets and specifically Western US markets? There is a difference, there is a divergence, because I know Asia markets are actually finding some support and recovering from oversold conditions, whereas here in the West, particularly in the US and with some of the European markets, it's still more bearish, I would say. So my question is, during this cycle of ups and downs, where we start with optimism, peak at euphoria, then we go through the cycle of fear, panic, despondency, and then finally kind of make our way back up to hope and optimism. What stage of the cycle do you think we are at? Do you think it's fear? Do you think it's panic? Or do you think it's hope? Fear, panic, or hope? I'm going to just let the poll roll for a few seconds and see which answer we get. Fear, panic, or hope. So fear, of course, is the early stage of the cycle, just after the market makes a top, and then we get a sharp correction down. We've already had about 20 to 30% corrections, depending on which markets you look at. That's actually in the West. If you look at Germany, it was down 40%. If you look at the Brazilian markets, that was down 80%. Asia markets will be, somewhere in between. So certainly we've had the fear. That fear likely extended into panic phase, but I want to leave it open to you whether you think we're still in fear or panic stage, or whether we're actually in this latest recovery in some of the markets around the world, pushing back to the hope psychology of things. So what stage do you think the market is in the current cycle? Now, looking at the, let's look at a quick kind of market snapshot just to see where we are in terms of real-time market trends. This is just a price performance chart looking at year-to-date, so how the markets around the world across asset classes have performed since the start of January. And you can see here in gold color, that is the gold market. Gold is still stable and now recovering back up. The blue lines are showing you the FX currencies, euro dollar, the pound, and yen, Japanese yen, all kind of flatlining. Of course, we do know that the dollar has had a very volatile up and down movement. So has the general kind of G10 complex. Equities in green, you can see the S&P 500, NASDAQ, and the DAX. They've had a big drop, but a recovery ever since. And then in black, we have the oil market, which really has been moving and shaking early this year on the back of that geopolitical heightened risk that took place. Fixed income markets, some of you might not be trading it, but you should be watching it because it does control economic macro policy, and it does very much drive some of the currency trends in terms of the return on investment that investors can get for using some of the currencies. Now, I'm just hearing back from Follow Me that we can actually have a look at the poll. So I'm going to try and flip to the poll and see if we can see the results. Just here, we can see there, what does volatility mean to you? 75% said risk, 0% said opportunity, and 25% said uncertainty. Wonderful. And I believe the second poll results should also be coming out soon. So interesting that most of you said risk, and of course that'll be the psychological experience of sudden change, especially when it leads to a trader losing money, or in life terms, something that is negative, like this whole pandemic COVID-19 situation. Uncertainty is an often one, and uncertainty is what people experience when they don't know what's going to happen, and different people will treat uncertainty in different ways. I do want to highlight one thing, though, that this opportunity result, the fact that most of you have said opportunity, haven't said opportunity, bear in mind that many traders and investors with good experience make money in risky times by seeing the risk as an opportunity. Okay, so let's go through to the next chart. This is on a very regular basis, daily essentially, and this shows price performance in terms of trend, key levels, and risk zones. And this is a trend filter chart. It just shows price swings, green for up, red for down, and what it shows is on the left-hand side, S&P 500 looking like we're going to get a rebound into 3,000 eventually, potentially, but the risk to that view is at 2,200. Just next to it in the middle top is the US dollar index. So you might not be trading the dollar index, but it is good to look at it because it does decide where many of the currencies like Eurodollar, cable and yen will move. And on the dollar index side, you can see there we broke to new trend highs, making a new multi-year high at 102.90, breaking above the psychological level at 100. We're now kind of back to that level. And so the view is for us to kind of continue with that uptrend. The trend should be your friend, into 103 and higher. So the dollar positive view. But the risk would be if we were to break down again below 94. Euro dollar, the view there is to go back down to the recent lows at around 106 and a bit, or 108.80 and another support level. Resistance is at 112, so that would be a risk level to the negative view. And then the bottom left-hand corner, we have gold, still looking very positive on a multi-year basis. The near-term target at 1612, but a risk level at 1535. That's just a key prior support. Oil, absolutely negative. I mean, into the historic lows at $20, but it's likely oversold, and we are seeing a rebound from oversold conditions, and there could be a short-term tactical move to 42 and a bit dollars. So that's my view on the oil market. And looking at long-term, so the bond market, long-term 10-year yields, we're at historic lows, and we're likely to stay there for a while. But for any potential rebound, that could take us back to 143. And even if you don't trade the 10-year yields, please take a look at it for economic policy changes and, of course, key drivers behind each of the markets, like the currencies and just a general state of play in the market. Now, I'm going to go through some market charts asking about this equity market crash, what it means, and what can you expect. If you want to follow my views, please do so on Follow Me. Here's a screenshot of a post I sent just a week ago. So just check me out and follow me, first and last name Ron William, and then you can start to track some of the market views and some of the mind strategies that I will share with you as part of my market and mind contribution to Follow Me. Now here's the view. S&P 500. This is the crash that we had in the US equity market and most world markets, down 30% in just 4 weeks. But now we've got this rebound from oversold conditions. I was short from 33.40 on the S&P 500. I made a small marginal profit because the volatility was quite strong, and there were a series of liquidation patterns, so forced selling in the market by big hedge fund and big players in the market that lost money during this big market crash. And you can see there the 3 candlestick patterns showing how you had late intraday session rallies that were later on squeezed back down to new lows. So the key levels on support is 23.47, that's the 2018 low, and 22.81, which is the risk level for now, probably closer to 2200 based upon latest price action. Now, for rebounds that may take place and have already partly taken place, the key levels on the upside are 26.45, 28.35, and 3000 or 3010. There are key cycles that have been active all this time. Certainly, that was the key trigger for my short position from the 14th of February and the 13th of Jan, just in and around the Chinese New Year. Now, this second chart is the one that I showed you, which was posted on the Follow Me platform, and it shows that, despite the rebound that we will likely get in equity markets, the view is actually more bearish than we probably want it to be, and we're likely to have an extended 30% further to go risk. So that would be a total of 60%, including the current move. And if you look at a long-term chart going back to the 1980s, most of you will not look at so much history, but I really encourage you to follow my big picture approach and to understand how long-term chart patterns, trends, and cycles do really make a difference to your day-to-day trading. Here we can see that there's this bull trap exhaustion signal outside of this 30-year trend measure. We broke back up. Many long positions got squeezed, so bulls actually got trapped, and then they moved back down to support, which is roughly around 2400. That level is, if we break below 2200, shall we say 2200 and a bit, that signals a long-term extended bearish move of minus 30% into 1600 on the S&P 500, and you can work out the equivalent on other world markets. Because of course, in a high volatility situation, most markets will fall together. That's usually what happens. Some will fall less than others, but in general, the direction will be down. Key levels there are 2000, 1700, and 1600. Now the 1600 level, what's very important about that is this is old resistance from the prior peak levels of the 2008 global financial crisis and the Y2K tech bubble, which we'll remember at least the 2008 global financial crisis and the tech bubble of 2000. Now, many people are talking about COVID-19 experience in terms of the shock of the experience as similar to SARS 2003, for those of you who, of course, will remember that in Asia, because that's where it hit hard. Or some Westerners are saying a little bit like a 9/11, in the sense there's no financial driven shock. It's more of this kind of black swan event. And I have I disagree with both of those views, because of course there are differences between each of these event risks. Every historical event risk is different to another. History doesn't repeat the same way. 9/11, SARS, and COVID-19, these are all unique events in their own right. But I do want to make the point that 9/11 and SARS in 2003, you can just see they're circled in green, and I'll just highlight it with my pen. This area on the chart was at the bottom of an equity market cycle. So after we had the Y2K crash, then we had the bottom of the market, and that's when we had the 9/11 experience, the terrorist attacks on the Twin Towers in New York, which led to the Iraq Gulf War, and then the SARS virus attack, which was mostly in Asia. After that, we then had a big bull market from 2003 to 2008. So it's a different time in history. Now we're actually crashing from a record-breaking price and time bull market. And so the fact that we had COVID-19 now, whether it was COVID-19 or any other event risk, it served as a pin that burst the mother of all bubbles. COVID-19 served as a pin that burst the bubble and the mother of all bubbles. So whatever the event risk could have been, it really later on will be seen as a perfect storm of events that would have still broken the bull's back, because the bull market was already vulnerable with or without COVID-19. That's the key message I want to highlight there. Now, if we look at the long-term chart, and this is a favorite beautiful chart that I like to look at quite regularly. It's one that I've created myself. It's 100 years data on the US equity markets, and you need that much data if you want to look at long-term cycles. These cycles alternate from bullish phases to bearish phases, bullish to bearish, so up to sideways or down, up to sideways or down. And each of those phases on average last 16 to 20 years. But if you just want to remember it as a round number, an easy number, that is a 20-year cycle. So on average, we have a 20-year cycle up and down. That does change in terms of the number, but what it shows now is that we have probably completed the prior cycle from 2000 into 2020. And we're likely in a reset period between this year and the next 2 to 3 years. So for a minimum, we're likely to have a 2-3 year bear market where the market will likely go sideways or down and prepare for the new bull market ahead, which we're likely to see from 2023 onwards. Notice that the big support level there, which is a 90-year support level, is the likely target on the current price action. Now, open question here. These are different shapes to a bear market. You can see it's a 3-stage process, not an event. So the 30% that we've had in the equity market crash, it isn't, that it isn't over yet. The pattern is usually a fall, rally, followed by the rest of the fall. A fall, rally, followed by the rest of the fall. So it's a 3-stage process: down, up, down, down, up, down. I really want you to memorize that: down, up, down. And the down up part is the V-shaped recovery that we're currently seeing in some of the markets. And so a lot of people are comparing that example with 1987 crash, because that's when we had the sharpest V-shaped recovery, which later on was a very strong bull market move. My problem with that, of course, is that 1987 crash was in a mid-stage of an 18-year bull market, and that's what I just showed you on the chart before. But we're likely to experience any one of the other examples I'm showing you here: figure 3, 4, 5, or 6. 3 and 4 show you in the middle the global financial crisis of 2008. 4 shows you the tech bubble, and then 5 and 6 show you the oil shock and the 1929 crash. Now, I want to call each of these charts good, bad, and ugly, just like the American Western movie starring Clint Eastwood: good, bad, ugly. And my question to you is, what do you think is the bear market in the next 2 to 3 years? What do you think it will likely look like? Good, bad, or ugly? What bear market roadmap is most likely in the next 2 to 3 years? Good, bad, or ugly? Are you looking for the 1987 V-shaped recovery? Are you looking for what happened in 2008, or the tech crash, which is more of a U or L-shape, a U-shaped recovery, or what happened in the 1970s or 1929, which is more of an L-shaped recovery? So V, U, or L-shaped recovery in global equity markets. Just going to quickly check that you've all been able to respond to that. I'm going to see if the poll is up. Good, bad, or ugly. And 100% of you are actually saying ugly. So we have a resolute bearish audience here. So I'm sure it feels, bearish and negative at this moment in time. Try not to be too bearish, and remember the crisis opportunity ahead, as is taught to us by Eastern Chinese philosophy in terms of the yin-yang balance. Now, I want to reintroduced this concept of VUCA, volatility, uncertainty, complexity, and ambiguity. Volatility is the up and down movement in the market, and I just show that to you on the VIX chart, and of course you've seen that in the 30% crash that we've had, and you've all said that we're likely to have an ugly situation in the market. Uncertainty is exactly what I think 25% of you actually voted for in terms of what volatility meant to you. That can be good or bad depending on how you act in an uncertain situation. Complexity is really what's happened. I mean, look, China tragically kind of suffered from the COVID-19 situation, but look what happened on a global level. I mean, in terms of the rest of the world also now dealing with the same thing, some countries more than others, depending on how government is responding. But also, we have a situation where there's a supply shock breakdown. So many of the countries which depended on supply from China or from any other part of the world is now having issues. So even here, myself in the UK, I just flew in from Singapore, and I've been in Asia for some time now, to be in the UK and be with family and friends. And just the day-to-day buying food at the supermarket has been an experience for me. I've been standing in line for an hour, waiting in line with a social distance of 2 meters just to buy food. So this is the complexity of a pandemic situation where it's now leading to supply shock breakdowns, which affects our daily life, simple things like buying food, because online delivery is an issue, and importing and exporting between countries is also under strain. Ambiguity is a little bit more of uncertainty, but this is just reminding us that there are multiple cause and effect factors. It's not just one. Now, I want to ask each of you, what VUCA experiences have you had? Now, we don't have a poll for this. This is just an open question. I need you to all write this down on a piece of paper, get a pen and paper right now. I'll give you 5 seconds to do that. And just imagine what VUCA experiences you have had. So on currency markets, commodities like gold, oil, equity markets, we've just had a 30% crash. So that's a great example already. Or we've had that, cliff drop down to $20 historic lows. Or it could be the dollar swing that we've had on euro, dollar, yen, pound, whatever it might be. What is your VUCA experience? What did you learn from it? And how did you later on develop a strategy or a best practice to actually maintain your edge during a VUCA times? This is a really important question that I want to challenge you all to ask. One of the things that might come up from you from that is how volatility influences our mindset. And as part of this markets and mind approach, I really want to remind everyone about the mind side of the markets and mind equation. Now, why does the mind matter? People drive markets. Emotions drive people. People drive markets, and emotions drive people. So the psychology of human beings really is at the heart of the psychology of market movements. And we mustn't forget that, no matter how technical we want to be in terms of developing strategies and even risk and money management, we must remember that psychology is at the heart of everything that happens in the market, because people drive markets. And looking at the people side, the human side of markets, we must remember that there's this inner game that is taking place. The brain, this ancient brain that we have that allows us to make these logical decision-making strategies, is driven by a survival computer. A survival computer that allows us to stay alive. Now, in ancient times, this survival computer would keep us alive from attack from a vicious saber-toothed tiger, as you can see there with the big sharp teeth. Here and now, it's not so much about a tiger or a lion, it's about losing money. And so, the body doesn't know the difference between being attacked by a tiger or losing money in a trading experience. The experience, the body experience is the same. This, the biochemistry that gets triggered in the body remains the same, and so we have the same symptomatic issues. Now, a lot of that stress that will result is also amplified not just by tigers or losing money, but also by this overload of technology and information. So you can see here this person with his mobile phone, tablet, and all this kind of electronic kind of age, digital age and information age, overloading the system. Think about all of the negative headlines that we're hearing about the pandemic. COVID-19 is really kind of weighing on us and making us even more stressed, especially we're in this isolation stage where it's even harder to do the daily activities that we do. That state of mind is in the bottom left-hand corner, right-hand corner, and these are the different brain states that can take place: beta, alpha, theta, delta. Beta is a heightened problem-solving state. It's quite a volatile brain wave, which is good to have, but not if you're chronically hyperactive, and beta is too volatile. Alpha is what happens when you're in a creative mind, potentially when you're having light meditation or mindful experience. It's very good for creating ideas ahead of a trade situation. Theta is more when we're approaching the dream state just before sleep, and delta is deep sleep, which you do need as a trader for rest and recovery. Now, in terms of the behavioral states of trading, the mind side of the market and mind equation, losing money is the #1 behavioral problem that we all suffer from. And so Daniel Kahneman, one of the godfathers of behavioral finance, who won a Nobel Prize for his work, says that the concept loss aversion is certainly the most significant contribution of psychology to behavioral economics. And one of the reasons why losing money is such a difficult thing for us, it's because we're fighting our biochemistry. We're fighting our biochemistry. So that should hopefully make you feel better about any losing positions, because it tells you that, from a brain state, from a biochemical research perspective, the pain of loss is twice as great as the pleasure of an equal gain. The pain of loss is twice as great as the pleasure of an equal gain. So this chart here shows you a trader that is losing money and making money, and on both sides of that equation, what actually happens in terms of our trader mindset reaction. And the reason why we suffer more from losses than we do from gains is because we're programmed for survival. And so anything that triggers our fear survival state will likely lead to a stronger reaction from the body, because that's how our body is built. Now, the flip side is also true. If I just show you here, overconfidence is an issue as well. If you're making money or you're just feeling very smart, as I have experienced in the past, and many of my friends have too, it's still a problem. I mean, this creates an addiction to market gains, but also a blind confidence in the market. And so here's a blind confidence of a mouse trying to find some cheese. And you can see there it's wearing its crown of knowledge, wanting to get that cheese and eat it because it's really hungry, and it wants to have its, it wants to be pleasured by the cheese. But this is at the expense of the risk of being killed in this mouse trap. And so how many of you have been in a situation where you've been too confident because of the technical knowledge that you have, or because of good profits that you've made, and for that reason you've taken on too much risk over the reward that you were so blindly hungry for? And so knowledge is not power, and we have to be very careful that the illusion of knowledge is exactly that. It's experience of specifically risk and money management that becomes so key to managing our behavioral conditions. The 3 practical steps that I suggest for all of you that are trying to make money in a volatile market or a VUCA environment, volatility, uncertainty, complexity, ambiguity, are these 3 steps which were mentioned on the video, which will be available on the Follow Me platform. 1, resilience, 2, divergent thinking, and 3, optionality. 1, resilience, 2, divergent thinking, and 3, optionality. Resilience, just to remind you, resilient markets and mind strategy, so an all-weather investment process, so a strategy that does well during the up and down phases in the market, active market timing and risk and money management. On the mind side, greater self-awareness, reduce behavioral bias, and improve stress response management. The number of traders that are suffering right now from excessive stress for so many reasons. This can be managed, this can be optimized, and it's something that I do on an active basis. Number 2, divergent thinking. We must think in terms of probabilities, not certainties. Do not assume that anything's going to happen in the market. Always work on probabilities, high or low, and make sure that the probabilities are grounded in a risk-reward payoff, a risk-reward equation. Avoid linear kind of one-way bets and try to hedge outlier risks. So, if you think the market's going to go down lower, how are you managing that risk? If you think the market's going to go back up, how are you managing that opportunity? Remember the crisis opportunity double meaning in Eastern Chinese philosophy. And that's all about divergent thinking. 3, optionality. We must think in terms of multiple scenario planning and prepare by studying historical patterns. History doesn't repeat, but it often rhymes. So it's the historical rhymes that we need to be testing, and not just the everyday rhyme. It needs to be the past anomalies, the extreme moves, the extreme volatility in the market, so that we can be better prepared for extreme times, not just normal times. One way to track market cycles, which is a great way of making money in volatile times, is to be tracking multiple cycles. And this is a chart here showing you long-term, medium-term, and short-term, or strategic, tactical, active. And this can apply to a trader or an investor. One tool which I recommend is just using basic moving averages. And we can see here long-term moving average, 200-day moving average, which is roughly the amount of days in a year. Medium-term moving average, the 50-day, which is roughly the amount of days in one calendar quarter. And then on the short-term side, 20-day moving average, which is roughly the amount of trading days in 1 month. So you basically can get a 1 year, 1 quarter, and 1 month momentum measure, but look at all 3 of them together and it gives you key trend signals in the market. Now, when these averages diverge, it's then telling you that the trend is changing and you might want to optimize your risk-reward parameters. Now, one final word is risk itself, and I really want to emphasize this point about how we need to take care of the market cycle and the money and the risk that we accept during that phase, those phases. So think about traffic lights, green for go, orange for wait, and red for stop. During the cycle, the time that we can make the most amount of money is actually during the danger zone. And you can see that the blue line just accelerating up, and I'm just going to highlight that, the blue line accelerating up. And it's during this phase, let me choose a different color. It's during this phase here, the peak stage, that we can make the most amount of money. The problem with that is we also take the most amount of risk on. So the risk reward is very poor, but because we can make so much money, we forget about the risk and we focus too much on the reward. Big problem, not just on the risk reward parameters, but also on the level of emotional intensity that we take on board. So really the best optimal time to be trading is during the low investment return but safe environment, or the middle of the cycle, which is just here, where you're making good money, but not too much risk. Anything beyond that, you can still trade, but just be very strong with your risk management rules. For example, if you're trading FX, I'd recommend trading 1%, 2% maximum of your portfolio. And if that's too big, then go from 1% to 0.5%. And I've spoken to many traders who have had a very hard time on some of the currencies like Aussie dollar or yen, which has had, multiple volatility. The volatility is 2, 3 or more times larger than usual, and they've had to decrease the amount of leverage that they have in their trade in order to survive and make sure that they can make money in the long term. Some wise words from a good friend and mentor of mine, Dr. Van Tharp, who's a leading trading psychologist, says, make a list of everything that can go wrong and determine how you will respond to that situation. That will be the key to your success, knowing how to respond to the unexpected. And the way that I describe responding to unexpected situations is this whole idea of responsibility. Responsibility is about how you respond. It's your ability to respond to extreme situations. It's being responsible and developing responsible scenario plans for situations like the one that we're in. A great way to actually also be responsible and develop plans is to look at the mistakes that you're making in the market and actually count how many times you're doing that. And if possible, add a money value to that. So these are different mistakes, emotional mistakes, stop management, risk management mistakes, or not trading your trading plan mistakes. Write them all down in a trading journal. Put down the reasons for those mistakes, poor mindset, loss aversion, lack of discipline, whatever it might be, and then work out the money value. And if you track that, you'll actually end up making more money because you're optimizing the risk of losing money on a regular basis. And often people don't know how much money they're risking or losing because they're not tracking the mistakes that they're making. And if you're not tracking the mistakes that you're making, then every decision that you make is a mistake by definition. You need to be having a trading plan and you need to be tracking your mistakes as part of a trading journal. I have a daily journal that I fill out on an active basis.